So, the first panel session is the ultimate guide on the fundamentals of ETFs. If you don't know the moderator, you should. I'm a writer in this industry, and to me, he's like a pro's pro. That's Todd Rosenbluth, who is now the head of research for VettaFi, formerly known as ETF Trends. Our panelists, Jillian DelSignore, head of advisor sales and ETFs for FLX distribution. Adam Schoffner, definitely the longest title in the group, director and fund chief compliance officer, distribution consulting for Foresight. And if that's not enough for you, don't worry, we got Mo. Mo Sparks is the director of exchange traded products for NYSE, also known as the New York Stock Exchange. So come on up, folks. You got your mics. Let's take it away.
All right, you can hold your applause. We're good.
You gotta sit and sync.
All right, a word to the wise if the next panels are here. These are comfortable chairs, and we will be sitting here for a while, and you're going to have to kick us out of these chairs on it. Well, thanks for coming, everybody. We were going to do introductions. I'm still going to do that, even though that was a great introduction, and I appreciate it. Just so we can respectively describe a little bit more how we fit into the ETF space and the role that we play. As mentioned, I'm Todd Rosenbluth. I'm the head of research at VettaFi. About 10 days ago, the ETF Trends, ETF Database, Alarian, and S Global Networks, which were all owned by the same company, decided to change our respective name to be VettaFi. We are a financial services company connecting advisors and asset managers together, and so this is actually the first time in public that I get to say VettaFi and not do it from my living room on camera, so thank you, Inside ETFs, for many things, including the opportunity to do that. Jillian, why don't you spend about a minute just on your role in the industry?
Absolutely. Thanks for being here, everybody. The very first panel of the conference. Jillian DelSignore, I am the head of advisor sales and ETFs at FLX Networks. Similar to what Todd just said, we are a community platform that brings together asset managers, wealth management home offices, and asset managers. I've been in financial services distribution for a little over 20 years and the ETF industry for, goodness, 15? This conference almost every year it's been around. So it's fun to be back and part of kind of a bigger event now. And looking forward to talking to everybody.
Thanks. Adam?
Great, thanks, Todd. Adam Schoffner, Foresight. I'm a fund chief compliance officer in their fund consulting group. 20 years in the financial services industry, primarily supporting mutual funds and ETFs, both in-house and then also at service providers as well. Currently, I'm the CCO for 2 ETF trusts. One is SHP ETF Trust, the other one Build Funds Trust, and also CCO for a closed-end fund as well. Happy to be here and great to be in beautiful Florida. Hopefully the weather picks up a little bit for us. I saw a lot of clouds, so I'm leaving 93 degrees back in Pennsylvania to come here, and it's 83, so that doesn't seem to make a whole lot of sense, but we'll see what happens.
Welcome. Mo?
Yeah, perfect. So a pleasure. It's nice to meet everybody. I will not give a weather report, considering we just were able to cover that, which is perfect. But yes, it is 95 degrees in New York City, so nice to be down here where it's a little bit cooler. But yeah, so I work with the New York Stock Exchange. We like to think about ourselves as the home of ETFs, right? So we are truly a platform for the listing and the trading of the most ETFs globally by count. We're approaching around 2,000. And I really help issuers through the entirety of the process of coming to market, right? And so many folks in this room I see as issuers themselves. I have spent a number of days, hours with them from kind of start to finish in that journey. And so prior to joining Exchange, I spent about a decade at the Vanguard Group, and so had worn the hat myself and doing product development and helped to found the product management function for the organization. So looking forward to the conversation and just a pleasure to be with such great people. So
Great. Thanks, everyone. So the room is intimate enough that we're actually going to do a poll just so that we get an understanding of where you are within the industry as well. So here are your three choices that I'm just coming up with on the fly on this. So you are either working within the asset management industry as an ETF provider / index provider / whatever Jillian and I would call ourselves as well. Those of us that are on here on the stage that I would call within the industry. Choice 2 is you are an advisor, thus a buyer of ETFs. And choice 3 is something else. You can choose what that is. So just by a show of hands, if we can just get a sense of how 101 versus 201 versus 301 to talk to. Within the industry, show of hands. Okay, thank you. Advisors. Something else. Okay.
Some of the something else's.
Well, I'm not going to have them out what it is, but I see a couple of reporters that are here. I would put that within the something else. It could be somebody who just wandered in because it's much cooler inside here than it is outside. Okay, so apologies. One last question. If you are an advisor, can we just get a sense of I heavily use ETFs, I moderately use ETFs, or what is an ETF? Okay, heavily using ETFs. Thank you. Moderately using ETFs. All right. Anybody want to say what is an ETF? Okay, I'm just throwing my hand up there to be able to do that. Okay, so we're gonna, in light of that, we're gonna speed through the ETF basics part of the conversation. Does that seem fair? Does anybody want us to not do that so that we make the best use of time here? Okay, so real quick so that I can say this to the camera on record and I can check the box for my continuing education credit. ETFs are cheaper, they are more liquid, they are available to trade on an exchange, including the New York Stock Exchange, I think is one of those places.
That is a fact, yes.
They are more tax efficient than most alternatives. They're just better than most alternatives. Anybody have anything they want to add to the ETF basics? You must know this before you can go into another session, before we then talk about what's happening within the industry and trends.
Did you say tax efficient?
I did, but you want to expand on that a bit?
Clearly, I'm listening intently to you. No, that's it. I just want to make sure we hit it.
Okay. Mo, anything on your end?
No, I think you hit the big one that obviously I would make sure it came across, which is accessible, right? So that is the key to the ETF wrapper, and something that's been revolutionary, right, is on your phone you can access, you can make a purchase just like that. You don't have to be a US investor. We've seen a ton of traction, particularly outside the US, even with US listed product. So a very key thing.
And low expenses, you hit low expenses,
Yeah,
right?
we hit low
The
expenses,
mutual
let's
fund.
let's spend a minute on that. Good.
May I, though?
Please.
So I think this is something important, and I think the collective we need to do a better job of talking about ETF expense ratios. I think that we've become programmed to think that ETF equals cheap beta. And what we will talk about, and if any of you were at Exchange, cheap plug, the Exchange conference technically still last month in Miami, there was a lot of discussion about active, and we'll talk about that here. The landscape has evolved meaningfully. ETFs don't and shouldn't all cost 2, 3, 4, 5, 7 basis points, right? Yay, yeah, someone's applauding. I think that I like to think about it cost relative to what? Right? And so maybe an alternatives ETF costs 75 basis points, but it's cheaper than 2 and 20. But large cap, market cap weighted beta probably should cost 2 basis points, right? So I just think they are less expensive, largely speaking, but aren't going to be the cheapest. They aren't always going to be cheap per se, right? They're going to be cost relative to something. I just think it's important to talk about because we get very trapped in that, I think, that mentality, especially for new folks coming into starting to use ETFs.
Agreed. In fact, it was on my agenda to be able to talk about as well, but we at VettaFi did a survey of advisors as part of one of our webcasts last week, and we asked from a due diligence perspective what was the most important thing in choosing, if they were to choose the ETFs we were talking about. And the choices included, I'll do my own poll and tell you the results to it. It was low expense ratio, it was issuer reputation, it was methodology, and it was how this can fit into our overall portfolio. And by far the least popular of choices was the cost of the ETF. So the reason I glossed over it is because people tend to think of ETFs that way, and now they're looking for something else, and they want to better get to know the ETF. So maybe we'll spend a bit of time talking about that and getting to know the ETF. Mo, let me just start with you from an exchange and a liquidity perspective. What should an advisor think about when they're considering an ETF and its liquidity?
Yeah, so obviously this is a really important thing, and it's a place where we all continue to educate, right? I think across the industry, as we think about liquidity, day one understanding of liquidity was secondary market liquidity. What is it trading ADV on the exchange every single day, right? We began to kind of measure against this bogey of a number, right? And that was really built upon the first ETFs being, as we discussed already, beta, passive, trading vehicles, things like SPY or IWM, right, that trade millions of shares a day. And I think as we've started to fundamentally understand the structure more, it's truly the liquidity of the underlying, right? And so what do I mean by that when I say liquidity of underlying, right? You're talking about the individual securities that comprise that ETF, right? So if it's the S&P 500, very simplistic, right? It's the 500 securities underneath, and how tightly each of those individual securities bid-ask spread is trading at a place like the New York Stock Exchange or other exchanges globally. So I think as we've kind of gone from 1.0 to 2.0 of understanding, it's starting to think about a measure like implied liquidity, right? And you can argue exactly what the right measure is, but just the thinking of being able to look underneath and see, for an asset class, what is a fair trading price, right? And seeing that in real time. And then it's starting to understand best practices for execution, right? So once you have kind of the understanding of going to your terminals or using some of the data providers that are out there to see where volume looks like, understanding the market itself, it's understanding when you should purchase and how you should go about that execution, right? And there's kind of two things I would say there. One is issuers across the US have unbelievable teams called ETF capital markets teams, who all they do every single day is pay attention to how well their ETFs are trading and partner with folks on execution. In particular, as you're starting to think about size and your execution itself, right? When you could potentially impact the underlying liquidity of individual security underneath, which could change your spread. And then the second is to just use to not use market orders, to just use limit orders, right? As we think about one of the primary things from an education standpoint that we still spend time with folks on is avoiding open and close on a general basis, right? Allowing for price discovery to occur. There's some things, I won't kind of go into all the details for this audience, but at the New York Stock Exchange that we've done to make that process better at open and close, but still generally speaking, be more cognizant. And two is use a limit order, right? Control and have price certainty in terms of execution. So those are a few things that I instantly think about, and I think as we as an exchange, as we go out there and we partner with folks and we have these conversations and sales teams, those are things that we're focused on. And then behind the scenes, right, as the platform for the trading of more ETFs globally than anywhere else in the world, we're trying to figure out every single day how we have the best technology to keep things as close to fair value as possible and to create the most incentive as possible for folks to come in and be trading things on an active basis, right? And so those things that we kind of probably in the tertiary hear about, lead market makers or liquidity providers, right? Folks like Jane Street or Flow Traders, Susquehanna, right, to give a few examples, ensuring that we're incentivizing them the right way to come in and trade product. So I know I kind of took that in a few different places, but I think it is worthwhile to hit on it because it's a really important topic.
Thanks. We're going to go down the line here just and then we'll come back around. But Adam, like, what's important for an advisor to know about ETFs? Like, what's your main message?
My main message for ETFs, and I'm kind of piggybacking a little bit off of the liquidity piece here, is ETFs are open-end investment management companies. So it already gives them a bit of liquidity over even what you would have with their stock brethren in the stock market, because ETFs can offer an unlimited amount of shares. As much as there's an appetite for it, then they're going to be able to provide those ETF shares, and so that's already another piece of the liquidity piece. I think with ETFs, especially since we're speaking to advisors here, it's kind of looking at those shops and seeing who they have at the top of the shop that's managing those ETFs. What's their caliber? What's their experience? Are they bringing to the table to do things that are a little bit different, a little bit contrarian than what you might see coming out of other places? For small shops, do they have partnerships in place in order to help them find lead market makers or find authorized participants that are going to help them get their ETFs out into the marketplace in order to generate liquidity and really make a market for that ETF? So I think it's really looking at who do they have for their relationships when they're out there selling these, and what are they doing that shows their expertise and also that makes their ETF a bit different than others. Even the active market right now, the active ETF market is getting a bit, you could say, I don't know that it's crowded necessarily at a little under $400 billion in active, but there's definitely a lot of folks out there in active management, and so really being able to figure out what's going to fit with your clients' portfolios.
Yeah, let me just, before you just to level set from active management, it's about 4% of the overall ETF marketplace. It's received double-digit percentage of flows thus far in 2022. It got that again it had that in 2021. So and we'll come back to active in a moment, so that I don't skip Jillian's opportunity to give her own due diligence. You're looking at the world from a different perspective, connecting with advisors and helping them out. What's your key message?
Yeah, and I would say I'm excited about the active conversation. I think that the active ETFs are definitely punching above their weight right now in terms of market share and flows. ETFs are tools, right? They're tools that provide access. I like to talk about them democratizing access to just a host of exposures, right? Ones we probably couldn't have ever dreamed of even a couple of years ago. We used to think that it was novel that an ETF offered exposure to emerging markets when I worked at iShares. Now, just think about what you're able to access on exchange for all the awesome reasons we already talked about ETFs. And I just think with that choice comes responsibility, and I mean due diligence, right? There are thousands of options in front of you as an advisor. It has to be overwhelming. I know it's overwhelming, and so I think there's an onus on I say myself, I'm not an issuer any longer, but on issuers to continue to educate, especially on those that are launching more sophisticated products. I'll say I don't like the word complicated or complex. I think more sophisticated product, or even just new, more cutting edge product. I think it's on them to help educate. But then also, I think on all the advisors in the room to come up with a really thoughtful due diligence process that I believe centers on what are you trying to achieve? What are we trying to achieve by putting this ETF in our portfolio? Because you could put 5 different ETFs that are seemingly, quote, the same in front of you, and I promise they're all different, whether the way they pick the securities, whether the way they weight the securities, the cost, the manager, whatever. And so coming up with a process that works for you that I do believe is centered around that, and then sort of branching out from there for all the reasons that Todd mentioned, right? The brand, the cost, the methodology, I think is a really good place to start. And we're happy to dig in when we get to the Q&A about other things, but that's kind of where I anchor myself.
So I'll do my version of it. So I have a slightly different hat now here at VettaFi, but I'm a big believer that what's inside an ETF is the driver of its future performance, much more than the past performance. If it's an index, then that track record is only so meaningful. You really need to take a look inside, make sure, especially when you're doing the slightly more expensive, not beta, not cheap-oriented products, whether that's a value versus growth, whether that's thematic in nature, whether that's sector-focused, lots of different ETFs that sound like they're going to be the same, but are quite different from one another. So that's extremely important, and you're going to hear a lot about different ETF concepts, and whether that's sectors or thematic. I think there's 6 different, perhaps, sessions tied to blockchain and Bitcoin and DeFi, which is, I guess it shows you where the industry is headed. Make sure you're doing your homework and understanding what your choices are and what they're not, to make sure that you're getting the right approach to it. So let's stick with active for a minute, and then we can cover some of the other key trends that are happening. Mo, I'm going to start with you again on the end because I'm going to butcher the numbers, so I know you have it fresher, but the number of actively managed ETFs that have launched within the last couple of years on the exchange has been tremendous. That's where you're seeing some of the new players come into the marketplace. You want to just expand on that a bit?
Yeah, happy to. And so, one of the things that I've been leading out for the exchange is really building out our platform to support active managers, right? As we've seen this kind of sea shift, and I like to think about it as the next wave of growth, right, for this industry, is we've quoted already small share, but growing really rapidly. And so, Todd, to your direct question, I think in the last 24 months, we've probably launched right around 300 to 315 active ETFs, right? And for consecutive years, you've gone north of 60% of new products launched have been actively managed, right? And so that's a pretty dramatic shift from if you look back for the prior 10 years. Many people forget the first active ETF was actually launched in 2007, and I love to quote it because it was from Bear Stearns, so rest in peace. But very innovative, right, at the time, but maybe too early, right? And so if we've seen this next wave, I think there's a few things to me that are really driving it, and I'm sure others will have perspective here. One, you have multiple paths to entry, right? And so what's happened in the last really 12 months or so is there's been some regulatory shifts that have resulted in an idea of a mutual fund to ETF conversion, right? And so a place where an asset manager can instantly kind of flip a switch, have an existing strategy come over, have scale, have some performance track record, some of the benefits that exist to having a legacy product, but carry it into the ETF wrapper itself. So that's one, is multiple paths to entry. Two, you've seen broader regulatory shifts, right? So there's something called the ETF rule that was passed in late 2019, and that really leveled the playing field, one, between mutual funds and ETFs, but also across ETFs, right? And so historically, you had a little bit of a process by which you had to go through from a filing perspective to get your product in market beyond just your traditional filing itself. That was eradicated, right? And so everything kind of gets like a stamp of approval. There's a few outliers that we can talk about. So that's two. And then three is you've seen kind of the legacy asset managers look and say, hey, I'm looking at my client base and understanding there's this massive wave over here happening in this vehicle called an ETF, and I'm not participating, right? And I have become wrapper agnostic across most of my business, right? I probably already have CITs, I already have target date funds, mutual funds, I likely have SMAs, right? I need an ETF wrapper to complement that, right? And so becoming wrapper agnostic has really been a focus for most of the asset managers, in particular at scale, as we've had conversations. And so they can say, hey, our goal is to come out and deliver the best investment strategy, and then to work with our clients, kind of as Jillian said, around what is the right solution for them and what the objective is for that client itself, right? Which I think is a really powerful thing and a good thing for asset management at large, right? So I think those things in particular are really nice tailwinds. And then the last thing I'd say is you have new solutions now for bringing a strategy to market and not having to be transparent every single day. And so something to shield some of that benefit that an active manager has historically looked to in the mutual fund wrapper and said, I don't want to disclose my holdings every single day, right? That's my IP, that's my strategy, that's how my research teams are spending all their time thinking about the next best stock. I don't want to just give that to somebody else to kind of pick me off. And so you've had a series of firms come to market with strategies that it's a really bad name. We call semi-transparent or non-transparent ETFs. I call them active ETFs, because we don't call mutual funds non-transparent mutual funds, right? They're delivering an active strategy. Yes, they disclose holdings on a different frequency. That's okay, right? They function very, very well, and that's a portion of the market that's growing quite fast, right? You have about 50 ETFs using a few different structures, one of which actually is the New York Stock Exchanges. And it's a space that's seen, between $3 and $5 billion in inflows over the course of really 2 years. So I think that's another place where there's a lot of tailwinds that we'll see more and more folks come and take advantage of having some additional flexibility even within the wrapper itself.
Jillian, you want to add? You wanted to talk about active. You want to expand on that? Mo did a good job.
No,
in
Mo,
setting the
you
stage,
you absolutely set the stage. Mo sends an email out every month that I love and where I get all my stats on the active ETF market. Now, I think you brought some really, really interesting points up. I think the ETF rule and the approval of the semi-transparent, agreed, terrible term, but the semi-transparent structure have really lowered the barriers to entry. And I think that over the last number of years, it's become pretty apparent that the ETF wrapper is the vehicle of choice. And asset managers who had historically been hesitant for one reason or another to enter the space, whether it's because the PMs didn't want to disclose their holdings or they didn't want to cannibalize their own assets, a whole host of reasons, are finding avenues to entry. And they're being able to now provide their clients with choice in coming into the market. Now, what's interesting is that as the barriers to entry have come down for issuers, and we're seeing this influx of product, the barriers to access have gotten higher. So I see some of our wealth management home office folks in the room, and I'm sure they can probably attest, their jobs as research and due diligence personnel at the various wealth management firms has gotten harder as they've tried to do due diligence on products and make them available to advisors. And so I think it's been an interesting quandary for issuers as they look to enter the market, but then realize they may not be able to actually access the advisors they want to distribute their product to. And so it's been really interesting to see that the semi-transparent products have begun to be approved. And so I don't know where the advisors in this room actually reside, if you will, if you're at a wirehouse or an RIA. But we are seeing more of the semi-transparent products be approved at the different home offices. So I think that the numbers that Mo quoted are going to rapidly accelerate. I think that's been sort of the one of the challenges in the system here in the last couple of years is seeing these products launch. Number one, they're active, and so they're gaining a track record. And I do think performance will drive a lot of the success of these products, because why do you buy active? You want to outperform. So I think I'm hesitant. People say, whether it's the media or whoever I'm talking to, do you think it's been successful or not? I'm really hesitant to place any judgment at this point, because they are active, they are gaining track record, and some are performing, some are not. And they are just gaining access to a large part of the advisor community. And so I think we should pump the brakes just a bit and see what happens over the course of the next year to 2 years as these products continue to gain traction. But I do think the numbers that Mo quoted are going to continue to grow pretty rapidly. It is really one of the only white spaces remaining in the ETF industry, if you think about it, with all that's been taken up with other product.
So I want to, I'm sorry, Adam, go ahead, freely add to it. I was going to
Yeah, no, that's right. Yeah, I was just going to say, with active ETFs, you're getting volatility management that you're not getting from their passive counterparts, and so that's a very important part to think about, especially when you're looking at, what are the different costs and that kind of stuff between passive and actively managed ETFs. They are going through their strategy, and they're able to make those different changes to the portfolio in order to help manage those other things. And I think we're probably going to touch on later, the other different trends that we're seeing in active ETFs, ones that have option overlay and covered call strategies and things like that, that are even then go above and beyond those, just the basic volatility management aspect.
Actually, well, let's do that, and I'll pivot in combine a couple of things in the interest of time. With the Fed raising interest rates, with inflation has been accelerating. We've seen advisors, and again, I'm happy for advisors to respond to this that are in the room, looking for alternatives to gain access to income than the traditional fixed income. It's only been this past month of May that we've seen money really starting to go into fixed income ETFs. They were sitting out most of the inflows in the first 3 or 4 months of the year. And what we've seen at VettaFi is that advisors are looking for higher dividend income-oriented strategies to get a chance for income, covered call strategies that offer either actively managed that include an income kicker available, whether that happens to be actively managed or they're index-based, but that's built in to part of it. do you guys want to talk about what you're seeing in that space from the income alternative area?
Sure. So one of the advisors that I work with, they have a fund that's invested 90 to 95% in fixed income, either fixed income ETFs or fixed income directly, and then also less than 10, so that's like 90 to 95% of the portfolio. The other part of the portfolio is then invest in covered calls. So they're able to get that downside protection by having the covered call strategy, and then also what was I going to say? In order to have that income piece like Todd was talking about. And so whereas that piece only represents a small version, a small piece of the actual amount of the ETF, from a gross notional value, if you want gross notional, not the delta adjusted value, it could be upwards of maybe 100% or whatever would be covered in these call options. But what we're seeing with these guys is there's just a desire in the market for them for those kinds of products where you're able to attach those call options on. This one happens to be options on on one of the indexes for the fund, and then complements the investments that they have in there as well.
So, Adam, as a compliance officer, are you allowed to give yourself the green light to name the ticker, or are you not, and people should come up to you afterwards to be able to do so?
I wasn't told that I couldn't say the ticker, and I did mention the ETF trust that I'm the CCO for, but that ticker is BFIX, BFIX, which is Build Funds Trust.
Okay. Compliance is looking over my shoulder constantly, but you happen to be sitting 2 seats over from me, so it's a lot easier to be able to do that. Jillian, Mo, anything you want to add on the income alternative side?
Yeah, I mean, I think what I would just add from what we see at the exchange perspective is innovation is definitely happening in that space, right? And so alternatives, so a lot of commodity strategies, a lot of option overlay strategies. The first wave was definitely like defined outcome buffer products, right? That kind of started as we think about structured products traditionally being offered in private wealth, right? Moving into a wrapper that is more accessible, and there's a few different issuers who have kind of brought those to market, and this is really the first big test for them, and I think that they've generally been pretty pleased with how they performed and have seen some good flows because of that. Inflation clearly with where it is, I think we'll see even more things. We see folks getting even more novel and looking at more advanced forms of structured products that include different options overlays, but I think those things are still kind of TBD in terms of whether they'll come to market or not, or when. But to me, it all comes back to it all happens because of the leveling of the playing field with the ETF rule, right? And so traditionally those things were kind of reserved for mutual funds, and with that passing, now you can bring those exact same strategies to bear in the ETF wrapper effectively.
Yeah, I would say in conversations with advisors, it's looking for income solutions. And I think that to Mo's point, the defined outcome products have been really interesting ways for people to look to leg their way back into equities in a more moderate way. Flex is actually an embedded partner in a new ETF, actually mutual funds trust as well. And I'll say a lot of the conversations we're having with issuers are related to both of those things, but also, and I think we'll touch on this, Todd, if we still have time, ESG. There's a lot of conversation, and the home offices that we're talking to are looking for more ESG product to make available to advisors. So that's been another one that we've seen start to pick up more meaningfully recently, as whether it's carbon neutral, rare earth, all sorts of different things to take advantage of sort of trends that we're seeing, and a lot of the wealth management firms looking to make more choice available to advisors in those categories.
So I'm glad you mentioned it, because I'm going to take a pause here because I think we have about 5 or so minutes left because we're having so much fun up here, and there happens to not be a clock in front of me, so I'm getting a 5-minute signal. So thank you. Perfect. Well, I'm getting various hand signals, but I'm just going to take the 5-minute mark, and we'll go over as necessary. So we're going to pause here. If anybody has a question that they'd like us to, or a topic they'd like us to cover, yeah, gentleman here in the front, and then we'll get you next.
Yeah, well, you were talking earlier about semi-transparent, non-transparent ETFs, the different ways that asset managers are kind of approaching that.
Yeah, no, I think it's a really good question. It's one that we spend a lot of time on. So I think, for maybe others in the room, just really quickly primer, kind of what's being referenced is there's a few different structure providers, someone like Active Shares, who has something that's truly non-transparent, right? So no holdings are disclosed to the market on any given day. And then you have a series of folks that kind of have what we call a proxy-based solution. And so the NYSE, Fidelity, T. Rowe, and then you have kind of a third set that's a fully transparent from Blue Tractor that reweights all of the weightings using a special algorithm, right? And so you do have a few players trying to compete and to provide IP for asset managers in the space. I think as we move forward, I think that you're going to see those three lanes continue to exist, right? I think that will be reality. Whether you have 5 to 10 different proxy structures, I'm not sure that will be the case. A little bit that's going to depend upon, I think, how quickly it expands into other asset classes. And so one of the limitations that those structures all have today is they can only invest in domestic equities plus Canada and Mexico. So really looking for international, maybe in time fixed income. And I think the pace by which that occurs will ultimately dictate whether we have a bunch of providers or just a few.
Sir? Yeah. No, you. Yeah.
There was an article a couple weeks ago in the Financial Times about ETFs. I went to the ETF conference, so I wanted to get maybe your perspective. That it's becoming the market makers and offer participants are getting just fewer and fewer and controlling the largest part of the market. Is that the case? Well, it was kind of an opinion piece. Is that happening, or are there more people? As ETF buyers and sellers, should be comfortable that those people are there? You should be apps they can listen to.
Yeah, no, I think it's a really good question, right? So it's a part of the ecosystem that we inherently at the NYSE are extremely focused on, right? As I said in kind of my opening comments, we think about it every day of like how we grow the pie, right? As we think about growing the pie, it's ensuring that there's an adequate number of service providers to service this industry at large. And trading is key to that activity, right? And so there's a few things that we've been doing, right? We've been investing back into the ecosystem to encourage other folks to come into market to play that role of being a liquidity provider. And so what I can say is, even in the last few years, I've seen, I think, 3 or 4 new folks come in and become kind of lead market makers on the NYSE. Right? And that comes from the fact that we've created some additional programs, again, I use the word incentives often, incentives to build a bench of folks so that they have a journey to get to that level, right? So they can support at that level or at a lighter level in ensuring that there's different pathways. So I think the industry at large is actually in a very good kind of place there because of the things that the exchanges are doing every single day to ensure that that's the case. That's my view. I'd be interested if any others would have comments.
Did you want to add that? It sounded like you did.
No. Yeah, you've got the expert there who answered. I thought that very well.
Do we have one final question? Yeah. Yeah, please, in the front.
Thank you. So how has the retail footprint in the ETF space evolved over the past 2 years?
So I'm going to ask I want to be on the same page with you. So retail being the end investor or retail being the advisors?
The end investor.
Okay. I'll take my stab at it, but anybody? I think we've started to see retail investors become more focused on ETFs. I think that they've helped to drive the growth we saw in the last couple of years in thematic-oriented ETFs, and they thus, Jillian was talking about also about due diligence and getting approved on various platforms. You can buy, thankfully, any ETF you want to at Schwab.com and Fidelity.com directly without having to go through that same due diligence and gatekeeper perspective. So I think they've been a big driver in that, but we're also seeing, I think, some of the money that's going in to the low-cost index beta products that's where folks are getting into the marketplace and dipping their toe in that regard as well. Anybody have anything else they'd add to it? As I see compliance over my shoulder here, making sure that I'm on schedule. Anybody else have anything else they want to add? Awesome. Well, thank you all for being a great audience, and enjoy the 3-4 days here in Florida.
Yeah, it said
and-
there's many things we didn't get to cover today. We thought that 40 minutes was going to be a long time. So
Well-
please approach any of us. Yeah, please approach any of us at the conference
Awesome. Well, thank
on
you,
anything
everybody.
you heard here.